Assalamualaikum and a very good day. I am AZARINA BINTI AZMAN, metric number 280894. I will start our group presentation on the topic stamp duty. So for the introduction for the stamp duty, we are referring to the Stamp Act 1949. The name itself is Stamp Act, not Stamp Duty Act. So stamp duty is a direct tax levied on certain instruments specified in the first schedule of Stamp Act 1949. The instruments refers to any written document. Written document. For instance, a sale and purchase agreement. Okay, there are two types of stamp duty, which includes fixed duty and also ad valorem duty. The fixed duty usually starts at a nominal value of 10 ringgit per instrument, while ad valorem is a stamp duty that varies according to the nature of the instruments and the consideration stipulated in the instruments or the market value of the property. As I mentioned earlier, stamp duty is levied on instruments specified in the first schedule of Stamp Act 1949. So the instruments must be duly stamped. What is duly stamped? Duly stamped is, as I list in the presentation slide, but before that I want to explain first that duly, the word duly is basically something in accordance with what is required or appropriate. So the stamp duty must be appropriate. So before I explain the four conditions that I have listed in the slide, I want to highlight that the amount that I might say in the four listed items is referring to the proper amount of initial duty, or amount of advance duty. I want to highlight that some situations might not necessarily mean the full amount of stamp duty itself. So the first one is duly stamped is when the instrument bears an adhesive or impressed stamp of not less than the proper amount or the other amount I said earlier. And second one is any official receipt for the duty stamp is affixed to the instruments. Affixed means attached. So the receipt and the instruments must be attached together. The third one is a stamp certificate for the stamp duty is attached to the instrument if the instrument is stamped through electronic medium. So there must be a stamp certificate if the stamp is paid through electronic medium. And the last one is the instrument is stamped by means of digital stamping for the stamp duty. Before I pass the presentation to the next member, I want to share one case I read on the website of a law firm, namely RDS Partnership, where the case name is AJ versus Permanent Duty Stamp. The case is related to stamp duty in Malaysia regarding the taxpayer entitlement to stamp duty remission. Let's start with the background facts in year 2019. A letter of offer was executed between Alliance Bank and the taxpayer where the bank agreed to provide a credit facility amounting 105 million ringgit to the taxpayer. This letter was sent for stamp duty adjudication where the taxpayer sought for the remission of stamp duty. So the purpose of adjudication is to ensure that the instrument is duly stamped to protect the parties of the contract and in respect of the admissibility of the instrument as evidence in court during a civil proceeding. So the next year in 2019, the collector informed the taxpayer that the instrument in the form of the letter of offer is not qualified for remission where the taxpayer has sought during 2018. Subsequently, the collector took the position that the letter of offer is subjected to stamp duty at the ad valorem rate and raised a stamp duty assessment. The stamp duty assessment is in the total of 525,000 ringgit. The taxpayer then paid the stamp duty under protest and submitted an application to object against the assessment. However, the taxpayer's application was rejected by the collector, and the collector provide no reason why their application is rejected. So being aggrieved by the assessment, the taxpayer subsequently filed an appeal to the High Court. So now we will continue to explain on the contention between the taxpayers and also the collector. As you guys can see in the slide, I have attached a part of the order that we have discussed earlier, where the taxpayers' contention regarding this case is they argue that the collector has failed to consider the clear wordings of the order. Okay. The order has stated that the amount of stamp duty that is chargeable under sub-item 22, section 22(1)(b) of the first schedule to the Act upon a loan agreement or loan instrument without security for any sum or sums of money repayable on demand or in single bullet repayment under that sub-item, which is in excess of 0.1% is remitted. Okay, single bullet repayment is a lump sum payment made for the entirety of an outstanding loan amount, usually at its maturity. So in short, in conclusion, the taxpayer is entitled to get refund 0.1% from the credit facility of 105 million ringgit, which means the taxpayer should only pay 105,000, and the balance should be remitted as they have paid a total of 525,000 as a result from the assessment in 2019. So let's move on to the collector's contention. The collector's main argument is that the letter of offer was correctly charged to stamp duty. The collector submitted that the letter of offer was not an instrument that is repayable on demand or in single bullet payment. Based on the letter of offer, the credit facility was for a definite period as the tenure is stated at 180 days. So finally, the High Court decision and comments on this case is that upon reading and hearing submissions by both parties, the High Court allowed the taxpayer's application on the premise that the letter of offer qualified for the stamp duty remission. Thus, the assessment raised by the collector was held to be erroneous. So erroneous means that the assessment by the collector is wrong. So at the end, the taxpayer will get the refund from the collector. That's all from me, and I will pass the next presenter to present the next subtopic. Thank you.
Assalamualaikum and hi, my name is Muhammad AIMAN. My meeting number is 281-897. So next we will look into the general principle of stamp duty. So there are 8 general principles for stamp duty as follows. Please pause for the slides. So the first principle is the doctrine of sustain over form. So the doctrine of sustain over form is the need to examine the sustain, not the form. So scope and amount of stamp duty is levied on this instrument is determined by the sustain, not the form. Meaning that whenever there is a transaction or there is an instrument of transfer, the tax officer needs to determine whether there is physically have over there. Maksudnya sebelum kita nak stamp duty, kita kena pastikan yang bahawa walaupun dah disenaraikan dokumen tu, dah diisi dokumen tu, tapi kita nak tahu juga kewujudan barang tu. We need to know the evidence physically. So the evidence need to be shown physically. So after that, we can impose stamp duty on that property or transfer. So the most example for this doctrine substitute over form is like a conveyance on sales and leases. So the conveyance on sale is a term that includes any property ownership transfer in the form of a gift, mortgage, lease, exchange, and etc. in the favor of the buyer. So lease is any financial transaction which is in the form of a lease or rental agreement where there is lessor and lessee. Okay. So by referring to the case Malayan Palm Oil Bulking Company versus Commissioner of Stamp Singapore, the fact is that Malayan Palm Oil Bulking Company Limited and United Plantation Limited made a document regarding the building. So they call this document as a core license and presented to the Commissioner of Stamp for stamping purpose. Then the Commissioner certified that the stamp duty of this core license was 101. The plaintiff not satisfied with the Commissioner assessment. So the issue is the said core license are document payable to stamp duty. So in this case, it was held that the building has been a rated building. So this core license is actually a lease made between the parties. Assessment made by the Commissioner was right and it should be stamped as a lease, not core license. Meaning that the building is already there. So it cannot be dianggap as a core license building because the building has already built in that land. So it should be treated as a lease. Okay. So in this case, it shows that the document the tax officer or the tax commissioner of stamps need to examine and determine the substance of the buildings over the form. So we know that the company Malayan Palm Oil present the document to the stamp officer, but the stamp officer need to determine whether the stamp should impose on what substance over there. So the substance is the buildings. Since the building has been erected, since the building has been built before the documents of lease to be designs, so because of that, the stamp duty will be imposed 101. So it's a higher stamp duty for this case. So the next principle is the stamp duty on instrument, not transaction. So stamp duties will be imposed on instrument and not transaction. Instrument is defined as any written document, and in general, stamp duty is levied on that legal, commercial, and financial instrument. For example, of instrument is subject to stamp duty is the real property transfer, share transfer, business transfer, rental or lease, or security transfer. So for more understanding, let's see on the scenario example on the situation where a house as a gift. So let's say a dad buy a house and give to the daughter. So the stamp duty will be imposed on when the dad buy the house. So this situation means that when the dad buy a house, it will be involved with banks, and then the instrument of transfer will be imposed from banks to dad, meaning that there will be a situation of transferring the names for the house, and then the second one will be imposed on when the dad transfer the house to the daughter. So bila nak transfer rumah kepada anak, so we need to transfer the names. So there will be instrument of transfer over there. So stamp duty will be imposed on instrument. So the next scenario is if the dad give cash to daughter to buy the house, then the stamp duty will be imposed when daughter buy the house only, because when dad give money to the daughter, is deemed as a transaction. So there is no instrument of transfer over there. Referring to the BASF Services Sdn Bhd versus pemungut duty stamp, the fact of this case is that the appellant acquired a piece of property from Perbanan Kemajuan Negeri Pahang. The total amount was 170 million, but the appellant report the purchase price is 84 million, excluded the development and infrastructure cost. So the stamp duty impose stamp duty based on the purchase price of the total amount, which is on the 170 million. The stamp duty imposed was unsatisfactory to the applicant. Then it was held that federal court, since the agreements entered by both parties includes the disposal of land and the carrying out of infrastructure work, the infrastructure fees constitute part of the payment for the transfer of the property. So the stamp duty levied on the document rather than the transaction. So in this case, it shows that the stamp duty will be imposed on the document of the total amount, because the stamp duty will be imposed on the instrument and not the transaction. So in this case, it shows that the excluded cost, which is the development and infrastructure cost, is the transaction that has been excluded by the applicant. So since the stamp duty will be imposed on instrument, so the instrument is when the document is signed with the amount of the total amount, which is 170 million. So next principle is leading and principal object. Principal instrument is the stamp duty subject to what described in the first schedule, and statutory instrument is subject to fixed duty of Rm 10 ringgit. So please refer to Stamp Act 1949 for the content and fees in the first schedule section. So section 4.3 of Stamp Act 1949 stated that party involved in the instrument shall determine which of the instrument is principal or subsidiary. So the company can determine the instrument will be principal or subsidiary. So referring to the Brownwood Sungai Berhad versus Lembaga LHDN, the fact of this case is that the property purchaser complete an SPA, paid the required stamp duty, and submitted a legitimate memorandum of transfer. So in this case, memorandum of transfer is known as, or is considered as, a principal instrument. And then it was unable to have the property transferred to it due to a scam by the attorney. And then after being sued by the vendor and the solicitor, he reached an agreement with them and cancelled the SPA. So in this case, the issue is whether the stamp is refundable or not. So it was held that the claim fall under section 57FI envision a circumstances in which the instrument is void ab initio and cannot be revived. It is not entitled to a reimbursement because it is complete legitimate transfer of the aforementioned land, and there was no issue with the aforementioned Form 40A being void ab initio, meaning that the property purchaser cannot claim for the circumstances instrument because it has signed a complete legitimate transfer to the attorney. So in this case, it shows that the memorandum of transfer is the principal object in the principle. The next principle is the separate and distinct matter rule. So if one single instrument are related to several distinct matters, the instrument will be subject to stamp duty as a separate instrument. So section 6B, an instrument that has been stamped with ad valorem duty but involves separate matters should be charged further. So this section has been supported by section 10.1. It stated that stamp that appear on one instrument cannot be used for another instrument. And then section 10.2 also stated that if two or more instruments are written in one piece of paper, it must be stamped separately. So referring to the Fish Levels Limited versus the IR Commissioner, it shows that the fact of this case is that Fish Level acquired IBS share and then sold it to the subsidiary company, which is Level Christmas. So the sale and purchase agreement of IBS share was made incorporated in one single instrument, even though the purchase first made by Fish Level and then sell it to the Level and Christmas in one day transaction. So the issue is is on the issue is on the return sales and purchase agreement. So it was held that clearly two different matters written on one agreement. Therefore, the instrument should be stamped separately because it involves distinct matters. So the next principle is the liability under two heads of charges. So this principle involves statement of liability of standard instrument and is liable to stamp duty within two different categories or heads. So if the distinct matter included separate consideration shall be separately charged. So looking at Speyer Brothers Appellants and Commissioner of IR, the fact of this case is that the United States of Mexico issues a gold coupon treasury note with a promise to pay principal and interest. So there is a two liability of head charge to bearer at a fixed date either abroad or at the option of the holder. The document comes within each of two categories chargeable with duty the stamp act. So the chargeable category is is the liability of principal to pay the principal and the interest to the bearer. So the issue is whether a document is chargeable with duty under two categories. So it was held that document contain a promise to pay and is therefore in a legal promissory note. Therefore, the instrument falls within both of the categories in this taxing acts. The crown is entitled to only one of the duty, but it may choose the higher one. So the next one is the contingency principle. An instrument will be subject to stamp duty by referring to its effect and to the circumstances as they exist at the time when it is executed. So this is a normal situation. But if at the time the relevant instrument is executed, it is not possible to determine the consideration, the stamp will apply the contingency principle. So under this principle, all the contingency are ignored, and if the relevant instrument sets at maximum limit for the consideration, the stamp duty will be payable on this amount. But in circumstances where no maximum amount is stated but a minimum amount is set, then that figure will be taken as the consideration of payable of stamp duty. So for more understanding, let's say that we look into the under a lease agreement where a landlord let a shop to a tenant and the rent amount payable is determined as follows. So the first situation is when the maximum amount is set. So the option 1 is rent is 1,000 per month. In the case of less than 50% of the rent is lettable. So this option 2 is RM 2,000 per month in the event that 50% or more of the lettable floor or the area is open for business. So in this case, the stamp duty will be imposed on the maximum limit sets. So if in the case of no maximum set but have minimum situation, the first option is that let's say the prevailing market rent is to be determined pursuant to an agreed procedure before the start of the issue, and then there is no maximum amount set over there. But the second option said that the rent of 10,000 per year. So there is a minimum limit that has been set by the landlord. So stamp duty will be imposed on the minimum amount of set. So when will be the contingency principle will be applied? So contingency principle will be applied when maximum or minimum amount is not acceptable. So let's say if the adjoining unit is not tenant, the rent is 10,000 per month. But if and from the date the adjoining unit is not tenanted, rent is 5% of the tenant monthly gross turnover at the shop. So in this case, the contingency principle has been applied in certain jurisdiction, such as that the amount of consideration that may be ascertained is the dutiable consideration, which is in this case is RM 10,000 per month. So that the tax officer need to apply the contingency principle to make sure that which is the best and which is the best to impose the stamp duty. So by referring to the LM Tenancies and Inland Revenue Commissioner, the fact of this case is that tenant lease two properties, and then the consideration in each lease is included the payment of premium calculated by a formula. The formula by the tenant lease is based on the price of certain stock at the close of business day, 25th business day after the date of the execution of the lease. So, and then the commissioner assess the premium to duty by the reference to the closing price of the stock on the day before the date of the execution, as the stock market was closed on the date of execution. So the issue here is whether the contingency principle is applied. So it was held that the duty was chargeable on the figure produced by applying the formula as in the leases at the date of the execution by taking the closing price of the stock on that date. So in this case, the contingency principle should be applied according to the formula by the tenant, because the contingency applied by the tax commissioner is before the date of the execution. So the tax commissioner believe that the stock market will be closed on the date of the execution. Therefore, the contingency applied is not to say wrong and not to say correct, but in this case, the stamp duty should be imposed after the date of the execution. So the next principle is the liability based on the fact existing at instrument date. So Section 5 of Stamp Act 1949 stated that all the facts and circumstances affecting the liability of any instrument to duty or the amount of duty with which any instrument is chargeable are to be fully and truly set forth in the instrument. So the collector may require such evidence to be furnished as may be reasonably necessary to prove that all such facts and circumstances are truly set forth. So the last one is the valuation for duty. Under Section 12A Stamp Act 1949, stated that when an instrument is chargeable with duty under item 32 subsection A of the first schedule, the date for determining the market value of any property being transferred, settled or given shall be, in the case of settlement of gift and transfer implementing a sale under a duly stamped agreement of sale purchase should be on the date of the execution of the instrument. Under the case of transfer of any property granted by a statutory body, a local authority or any cooperative society registered under any law, so the execution date should be on the final term of the transfer had been communicated to the transferee. So in the case of subsequent resale of the property is on the date of consent by the statutory body or local authority or the board of the cooperative society for that resale. Next one, in the case of transfer under a duly stamped sale and purchase agreement where financial arrangement has been made in accordance with the Sharia, so the date is on the date of execution of agreement. So if other case is on date of execution of the instrument of transfer. So referring to the Chin Choi and others versus the collector of stamp duties, the fact of this case is that the taxpayer enter into an agreement to purchase a two-story shop from Bottom Property Sedan Berhad in 1971. So this is the date of execution of sales and purchase agreement. Then the taxpayer paid a portion of the purchase consideration, but the property was only transferred to the taxpayer in June 1973. So this is the date of execution of instrument of transfer. And then the valuation officer used the market value on the date of execution of the transfer to compute the ad valorem duty payable. So the collector applied the market value for stamping purpose based on the valuation report and imposed ad valorem duty. So in this case, the issue is whether the stamp duty payable should be based on on the market value of the date of sales and purchase agreement, or the market value when the instrument of transfer was executed. So it was held that the collector has made the proper assessment as the correct value of the property to be applied in calculating the stamp duty payable was the market value at the date of the instrument of transfer executed. So that's all from me. Thank you.
Assalamu alaikum. My name is Mohamed FARDOWSO Salat. My matric number is 249873. I'm going to present about chapter 10 stamp duty. So subtopic for instrument not duly stamped. So for this not duly stamped instrument, an stamped or inefficiently stamped instrument is not admissible as evidence because in a court of law nor will be acted upon by the public officer. So under section 51 sub 1, every person having by law or consent of parties authority to receive evidence, and every person in charge of public office, exception for an officer of the police. So for under section 51 sub 2 also said for that person, every such person shall examine every instrument so chargeable and so produced or coming before him in order to ascertain whether it is stamped with a stamp, and that and also of the value and the description required by law in a force in Malaysia when such an instrument was executed or was executed, provided that provided that nothing herein containing shall be deemed to require any magistrate or judge to examine or compound. If there is nothing fit to do so, any instrument coming before him in the course of any criminal proceeding. And then number B for section 51 sub 2, in the case of judge of the High Court, that the duty of examining and compounding any instrument under this section shall be performed by the registrar. So under section 52 of the Stamp Act 1949, the Act stipulated that the instrument is specified under the first jadwal of the Act must be duty stamped by the IRV of Malaysia in the manner specified under section 40 and section 47 of the Act to enable the instrument to have a complete legal effect by being admissible in a court as evidence. So under the Act, if the person fails to stamp the instrument within the period stipulated, he or she will be liable to pay for the unpaid payable duty together with the penalty imposed under section 47A, which provided as follows. So number 1, RM 25 ringgit or 5% of the amount of the deficiency duty, whichever sum be greater if the instrument is stamped within 3 months after the time of stamping. So number 2 says RM or ringgit 50 ringgit or 10% of the amount of the deficiency duty, whichever sum be greater if the instrument is stamped later than 3 months but not later than 6 months after the time for stamping, or 100 ringgit or 20% of the amount of the deficiency duty, whichever sum of to be greater in any other case if the instrument is stamped beyond 6 months after the required time for stamping. So that the issue is whether the unstamped instrument have validity. So that the cases is the Federal Court case of Malayan Banking Berhad P Agency Service Barayu, Sadiam Barhad, and ORS 1982. So that in this case it was the legal position to address the issue of the validity and stamped instrument can be seen in the Federal Court of Law. So that way it was held that an stamped instrument only affects the admissibility of the instrument in evidence, but it does not render that the particular instrument to be invalid. So the court was held that the stamp objection really relates to the safeguarding the government revenue unless if the non-stamping goes to the root of the validity of the instrument or the case is on revenue dispute. So that again another case said Omega Securities Yambar had with Dr. Hamza bin Abdul Majid 2011 and MLJ 12. So that way in this case the issue rises before the court was whether the margin facility agreement is unvalid due to the non-stamping of the said agreement, so that in the court in this case has made reference to the principles used in the federal court of case of Malayan Banking Berhad and further held that so that in this case the non-stamping of the margin facility agreement did not go to the root or validity of the document. It was only an issue of the government revenue. Therefore, the margin facility agreement remained to be valid. So that the last one is decision. The last one is decision making. So the decision making is that based on the above authorities or the above stated cases, it appears that unstamped agreements remain to be valid despite being inadmissible as evidence in the court. As such, any party that wishes to render an stamped agreement in a court are required to get an agreement stamped for it to be admissible as evidence.
Good day to Dr. Idawati and my dear friends. My name is VELLAN son of SELVA and my metric number is 28897. Now I would like to present about the subtopic which is allowance for spoiled stamps under the section 57, 58 and 59. It also consists conditions of granting allowance and the limit of the claim. In this slide, I would like to explain about the section 57 which is allowance for spoiled stamps, where it states on how a person can apply for a refund of spoiled stamps under this section. For example, if the stamps on any paper get spoiled or document on which is written but not signed, or if the stamp has not been attached to any paper and the collector agrees with the assessment that is unusable, it may still be considered for a refund or replacement. Or if a promissory note has a stamp on it but it has not been utilized or transferred to anyone and is still in the possession of the maker, the stamp may be eligible for a refund or replacement. The stamp must not have been used in manner and note should not have been delivered out of the maker's hand. Or if a promissory note has a stamp on it but due to an error or omission, the note become unusable, and it may also raise a refund or replacement may be possible if a new and identical promissory note is produced. The new note must have the same stamp and be identical to the spoiled note in every way except for the correction of the mistake or omission that caused the original note to be unusable. In this slide, I would like to explain about section 58, which is allowance for misuse stamps, and section 59, which is allowance on how to be made. In section 58, allowance for misuse stamps states that when a person use for an instrument is liable to duty stamp greater value than necessary or not liable to any duty. An application can be made within 12 months after the date of instrument, or if any, it is not dated within 12 months after the execution thereof by the person by whom it was first or alone executed. Under section 59, in any case in which allowance is made for spoiled, unused or misused stamps, the collector should give in lieu thereof the same value in money. In this slide, I would like to explain one example of the case that is related to the allowance for spoiled stamps under section 57. The name of this case is Galaxy Energy Technologies Sdn Bhd versus Timbalan Pemungut Duty Stamp, Malaysia. The issues of this case is whether the appellant's case came within the meaning of inability under Section 57, subsection F, Roman 4 of the Act. And the fact of this case is about the appellant and the vendor agreed to buy a plot of land. The remaining purchase price was due in 90 days. The collector assessed the stamp duty at a price of 78,600. The appellant paid up. The vendor later terminated the SPA because the appellant was unable to obtain a loan to cover the remaining purchase price. The vendor forfeited the deposit and requested the return of the executed MOU. The appellant then sought a stamp duty refund under Section 5, subsection F, Roman 3 and Roman 4 of the Stamp Act 1949. But yet, it get rejected by the collector. However, the decision and the principle of this case is the appeal was allowed. It is a matter of fact whether a person meets the definition of inability in Section 57, subsection F, Roman 4. It was an inability under Section 57, subsection F, Roman 4 of the Act that the appellant did not complete the SPA. In this slide, there are certain conditions for granting allowance under Section 15, subsection 2 of the Stamp Duty Act, which provides the relief from stamp duty in the case of a transfer of a property to achieve greater efficiency in operation between associate companies on any instrument if the collector of the stamp duties is satisfied with these following conditions. If two associate companies transfer a beneficial interest in a property from one to another, the transaction results in the transfer of ownership without affecting the limit liability of their company. Each of the company has not less than 90% of its issued share capital beneficial owned by the third company with limited liability. The transferee company must be incorporated in Malaysia. Finally, in this slide, I would like to talk about the time limit for the claim. The claim can be made within 4 years from the date on which the instrument written document was revenue stamped as indicated on the stamp certificate, or if a person wants to claim a refund of stamp duty paid on certain instruments combined with a building agreement or for a dwelling house or apartment, or certain leases combined with a building agreement for a dwelling house or apartment, they must do so within 3 years of the date on the stamp certificate. That's all for me. Thank you.
Assalamualaikum and hi, my name is Muhammad Zuhairi Zulkefli and my metric number is 280681. I will continue with the part of penalty. So I will start with the penalty for late stamping according to the section 47A1. So an instrument which is not stamped within the period specified in or under section 40 or 47 may be stamped on payment of the unpaid duty. So the penalty imposed for late stamping varies based on the period of delay. The maximum penalty is RM 100 or 20% of the deficient duty, whichever is higher. Next, I will continue with the penalty period. So the first one, if the instrument is stamped within 3 months after the deadline, the penalty is either RM25 or 5% of the deficient duty, whichever amount is higher. The next one, if the instrument is stamped after 3 months but within 6 months after the deadline, the penalty is either RM50 or 10% of the deficient duty, whichever amount is higher. And the last one, if the instrument is stamped after 6 months after the deadline, the penalty is either RM100 or 20% of the deficient duty, whichever amount is higher. So the last part is about the prevention from leaving Malaysia. If the taxpayers are suspected of leaving Malaysia without paying the required duties, penalties, or other sums, they can be prevented from doing so. The collector has the authority to issue a certificate containing the relevant information to the Commissioner of Police or Director of Immigration, requesting that the taxpayer be prohibited from leaving Malaysia until all the duties, penalties, and other amounts owed are paid. And that's all from our group presentation. Thank you.